Silver gave 250% returns in 1 year, from $32 to $121 in 12 months. That is the kind of move that changes people's lives. And then silver did what silver always does. It punished everyone who got comfortable. It crashed from 121 all the way to 64, almost 50% wiped in weeks. And for the past month and a half, silver has been grinding sideways between 64 and 90, chopping, bleeding, frustrating every single person who owns it. The social media crowd has gone quiet. The YouTube comments have gone from rocket emojis to funeral emojis. And the mainstream financial media is already writing silver's obituary. But I have 3 charts today that are about to flip everything you think you know about this market upside down. These are not daily charts. These are not weekly charts. These are charts that span 25 years, 45 years, 53 years. The kind of charts that only matter once in a generation. And they're all screaming the same thing right now. One of these charts shows a silver target above $500. Another shows an oil target of $369. And the third shows that gold is in the early stages of a move that could reset the entire global monetary system. I am not making these numbers up. The charts are going to show you the math. Stay until the end. Welcome to the growth grid. Hit like and hit the hype button right now. These are the most important charts I have ever shown on this channel. Let's go. Let me start with the silver chart, because if you own silver and you are watching the price at $80 feeling sick to your stomach, this chart is going to change the way you see everything. Pull up the silver yearly chart, not the daily, not the weekly, not the monthly, the yearly. 45 years of silver price history on one screen, and what you see is the most powerful technical pattern in all of charting, a cup and handle. But not just any cup and handle, the mother of all cup and handles. The cup starts at the 1980 all-time high near $50. Silver crashed from 50 in 1980 and spent the next 44 years building a base. It went down to $4. It came back to 50 in 2011. It crashed again to 12. It came back to 30. It pulled back to 18. Every one of those moves was building the right side of the cup. And the neckline of this pattern sits at $31 to $32. Not 50, 31 to 32. That was the level that mattered. And silver broke above it in 2024. The breakout happened. The 50-year cup and handle triggered. Now here is where the math gets interesting. When a cup and handle breaks out, the measured move target is the depth of the cup added to the neckline. The cup is roughly $32 deep from the neckline to the bottom, but this cup has a fractal pattern inside it, a smaller cup and handle that already played out with an 823% move. When you apply the same fractal math to the larger pattern, the long-term target is $370. And at the end of a bull market, when things overshoot, the spike target is above $500. 370 to 500 plus from 80. That is 4 to 6 times the current price. And the chart pattern that produces these numbers has been building for 45 years. This is not a 2-week pattern on a 4-hour chart. This is nearly half a century of price action pointing in one direction, up. And here is what I think most people are not grasping about what happened in the last 12 months. Silver went from 32 to 121. That is a 250% move in 1 year after breaking out of a 45-year base. That kind of move does not happen in a bear market. That kind of move does not happen at the end of a bull market. That kind of move happens at the beginning, when the pattern first triggers, when the energy that has been compressed for decades finally releases. And the first move out of a 50-year base is never the only move. It is the announcement. The real move comes after the consolidation. And that is exactly what we are in right now, a consolidation. Silver went from 32 to 121, and it needs to rest. It needs to digest that move. It needs to shake out the weak hands who bought at 100 and got scared at 80. It needs to reset the technical indicators that got stretched to extremes during the rally, and then it goes again. That is how every breakout works. Breakout, rally, consolidate, rally again to new highs. The consolidation is not the end, it is the middle. I know it does not feel like the middle when you're sitting in it. When silver drops from 121 to 64 and then grinds sideways for 6 weeks, it feels like the end of the world. I get it. I feel the same frustration. But zoom out. Look at the yearly chart. Silver consolidating between 64 and 90 on a chart that spent 40 years below 32 is not a death sentence. It is a pullback within the greatest breakout in silver's history. And pullbacks within breakouts are where the smartest money accumulates, not at the highs, at the consolidation lows. This is accumulation territory. And let me tell you what accumulation territory actually looks like. Because I think people have a romantic idea of what buying the dip feels like. It does not feel good. It feels terrible. It feels like you're throwing money into a hole. It feels like everyone on social media is laughing at you. It feels like the crash will never end. That is what accumulation territory feels like. If it felt good, everyone would do it, and the prices would not be low. The reason prices are low is because accumulation territory is designed to feel awful. That is how it shakes out the people who do not have conviction, and it concentrates the physical metal into the hands of the people who understand what the 50-year chart is telling them. Every major bottom in this bull market felt terrible at the time. Silver at 18 in 2020 felt terrible. Silver at 12 in 2020 felt terrible. Silver at 22 in 2022 felt terrible. And every single one of those terrible feeling moments was followed by a rally that made new highs. The pattern does not change. The emotion does not change. Only the price level changes. And at $80, the emotion is the same as it was at 18. Fear, doubt, frustration. The only difference is that at 18, the 50-year breakout had not happened yet. At 80, it has. The macro case is stronger now than at any previous bottom, and yet the emotion feels the same. That tells you something about how markets work. The best opportunities always feel the worst. Now let me show you the gold chart because it confirms everything the silver chart is telling you, and it adds a dimension that changes the way you think about what is happening. Pull up the gold chart. 53 years of data from 1971 to today, and what you see is a pattern called 3 drives up. 3 distinct bull moves separated by long consolidation periods, and we are in the third one right now. The first bull move started when Nixon ended the gold standard in 1971. Gold went from $35 to $850. That was a 2,400% rally. Then it consolidated for 20 years from 1980 to roughly 2000. 20 years of nothing. Gold went from $850 to $250 and back to $500. 20 years of building a base. The second bull move started around 2000. Gold went from $250 to $1920 in 2011, a 900% rally. Then another consolidation. From 2011 to roughly 2020, 9 years. Gold went from $1,900 to $1,000 and back to $2,000. 9 years of going nowhere. The third bull move started in 2020. Gold broke out above the $2,000 consolidation range, and it has gone from $2,000 to over $5,600 at the highs. That is already a 180% move. And based on the pattern of the first 2 bull moves, the third one is the largest, 2,400%, then 900%. Each move was smaller than the previous. But the analysis on this chart suggests the third move will be the biggest of all, because this time it is not just a bull market. It is a monetary system reset. Here is what that means. The first bull move happened because the gold standard ended. The second happened because of the financial crisis and money printing. The third is happening because the entire post-Bretton Woods fiat currency system is being tested. War, inflation, de-dollarization, central banks buying gold at record pace, debt spiraling out of control. This is not gold going up. This is currencies going down. And when currencies go down against gold, in the context of a monetary system reset, there is no bubble, because the new system will be backed by gold at whatever price it reaches. The gold does not come back down. It stays there, and a new monetary order is built on top of it. That is why the third bull move on this chart is annotated as the one that kills the present global monetary system, because that is what is happening in real time right now. While people are panicking about a $200 pullback in gold from $5,200 to $5,000, the 53-year chart is telling you this move has barely started. Now let me show you the oil chart because this is where the war connects to everything. Pull up WTI crude oil 25-year monthly chart. And what you see is a massive inverse head and shoulders pattern that has been building for 21 years. The left shoulder formed around 2008 when oil hit 147. The head formed in 2020 when oil crashed to -40. and the right shoulder has been forming since 2020, with oil building a base between 40 and 90. Recently, oil broke out of a red falling wedge pattern that has been acting as a halfway pattern. On March 9th, oil spiked to 100 in 1950. That breakout above the falling wedge is significant because in technical analysis, a halfway pattern means the move that preceded it is only half done. The measured move from this breakout using the formula on the chart comes to $369. $369 oil. I know that sounds insane, but look at the chart. The 21-year inverse head and shoulders has a measured move that is calculated by taking the depth of the pattern and adding it to the neckline. The depth from the head to the neckline is roughly 83% of the neckline value. Adding that to the breakout level gives you a target well above 300. And the falling wedge halfway pattern independently confirms the 369 number using a different calculation method. Two different methods, same target zone. And here is where the war makes this target not just possible, but likely. The Strait of Hormuz is closed. 20% of global oil supply is trapped. The IEA said this is the largest oil supply disruption in the history of the global oil market. Let me repeat that. The International Energy Agency, the most authoritative voice on global energy, said this is the largest supply disruption in history. Not since the oil embargo, not since the Gulf War, in history. 8 million barrels per day gone in March. Iraq's production collapsed 70% to 1.3 million barrels per day. Kuwait declared force majeure. The UAE and Saudi Arabia are running out of storage and cutting production because there are no tankers to load. And here is what $369 oil would mean for the world. Gas at the pump would be $12 to $15 per gallon. Airlines would ground half their fleet. Trucking costs would triple. Food prices would double because everything you eat is transported by diesel. Heating costs would devastate middle-class families. Manufacturing would shut down. And inflation would make the 1970s look mild. That is not a prediction. That is the math. If oil triples from current levels, everything that depends on oil, which is everything, triples too. Oil feeds into 45,000 products. And the 25-year chart says the technical target is 369. I'm not saying oil goes to 369 tomorrow. Charts give you targets, not timelines. But the pattern is there. The breakout is confirmed, and the war is providing the fundamental catalyst that could accelerate the move. The paper oil market is pretending everything is fine. Reuters published an article this week that said crude oil futures are separate from reality. The paper price of Brent crude is $92. But the physical premium for a cargo of Dubai crude over its paper equivalent rose to almost $38 per barrel. $38. The physical oil market is telling you that real oil, oil you can put in a tanker and ship somewhere, is worth $130, while the paper market says $92. Jet kerosene hit a record $225 per barrel on March 4th. The supply chain is buckling. Countries are hoarding crude and fuel. And this paper versus physical disconnect is not just happening in oil. It is happening everywhere. In silver, the Shanghai price is $94, while COMEX says $80, a $14 gap. In gold, Dubai flights are grounded and 20% of the world's gold supply chain is frozen. The physical world is separating from the paper world across every commodity simultaneously. And the paper world always loses that fight eventually, because you cannot heat your home with a futures contract. You cannot build a solar panel with a paper silver certificate. You cannot fly a plane with a derivative. And here is a detail that I think proves the silver shortage is real beyond any doubt. A company called Monetary Metals is currently offering 12% annualized returns to lease your physical silver. 12%. They are partnering with StoneX, one of the largest commodity brokers on earth, and a COMEX clearing member to borrow physical silver from retail investors. I want to stop here and make sure you understand what is happening. StoneX is not a small company. They operate on 40-plus derivatives exchanges. They have offices across 4 continents. They are a major player in the global precious metals market, and they are so desperate for physical silver that they are going to retail investors, people like you and me who have silver bars in their safes, and offering to pay 12% per year to borrow it. 12%. Let me ask you a simple question. If there is no silver shortage, why would anyone pay 12% per year to borrow silver? Normal silver lease rates are 1 to 2%. 12% is desperation. That is a company saying, "We need physical silver so badly that we will pay you 6 to 12 times the normal rate to get it." That single data point tells you more about the state of the silver market than any price chart. The price says 80. The lease rate says emergency. And lease rates do not lie, because they represent the actual cost of obtaining physical metal. When the cost of borrowing silver goes to 12%, it means the market is so tight that institutions are bidding against each other for every available ounce. While the paper price goes down, the cost of borrowing the actual metal goes up. Those two things cannot exist in the same reality for long. One of them is wrong, and I know which one I trust more. Now let me connect all three charts together because the picture that emerges is something I have been thinking about all week. Gold is in its third bull move on a 53-year chart, a move that could reset the global monetary system. Silver has broken out of a 45-year cup and handle with targets of 370 to 500 plus. Oil has broken out of a 21-year inverse head and shoulders with a target of 369. And all three breakouts are happening at the same time. During a war, during the largest oil supply disruption in history, during a dollar crisis, during a bond yield explosion, during the unwinding of the global monetary order. This is not a coincidence. These three charts are telling the same story from three different angles. The fiat currency system that has governed the world since 1971 is in the process of failing. Gold is pricing in the failure. Silver is pricing in the failure. Oil is pricing in the failure. And the paper markets that have been used to suppress the real price of these commodities for decades are losing their ability to do so because the physical reality is overwhelming the paper fiction. And the war is the accelerant. Without the war, these charts would still be playing out, but over years. With the war, they are playing out in months. The Hormuz closure compressed years of oil supply tightening into weeks. The Dubai shutdown compressed years of gold supply chain stress into days. The COMEX volume collapse compressed years of silver market drainage into a single month. The war is not creating these patterns. The patterns were already there. The war is forcing them to resolve faster. I sat with these three charts side by side this morning, and I kept coming back to the same thought. We are living through a generational event, not a trade, not a cycle, a generational shift in how the world values real assets versus paper promises. The people who understand this and position accordingly will be on the right side of the greatest wealth transfer in modern history. The people who are staring at the daily chart, watching silver go from 81 to 80 and panicking, are missing the forest for the trees. The daily chart does not matter. The yearly chart matters. The 50-year chart matters. And the 50-year chart says this is just getting started. I have been covering this market every single day for a long time. I have shown you COMEX delivery data. I have shown you vault drain numbers. I have shown you war impact analysis. I have shown you dollar mechanics and bond yields and Shanghai premiums. All of that is important. All of that matters for the short term. But today is the video where I want you to step back from the short term and see the long-term picture. Because the long-term picture is the one that determines whether you look back at this period in 5 years and think, "I cannot believe I was worried about $80 silver," or whether you look back and think, "I cannot believe I sold at 80 because I was scared." Every generation gets one chance to be on the right side of a monetary system shift. The people who bought gold in 1971 got a 2,400% return. The people who bought gold in 2000 got a 900% return. And the people who are accumulating physical gold and silver right now during this consolidation are positioning for the third and potentially largest move in the 53-year cycle. This is that chance. It does not come around often, and it never feels comfortable when it arrives. Silver at $80 after giving 250% in a year is not a disaster. It is a gift. It is the consolidation within the breakout that gives you another chance to accumulate before the next leg. The smart money knows this. That is why Monetary Metals is paying 12% to lease your silver. That is why StoneX is partnering to borrow physical metal. That is why Shanghai is paying a 13% premium. That is why COMEX longs are rolling backward for immediate delivery. The smart money is not selling silver at 80. They are fighting over every available ounce. The war makes accumulation time shorter, not longer. Every day the Hormuz stays closed. Every day Dubai flights remain grounded. Every day the IEA reports another 8 million barrels of supply gone. Every one of those days pulls the timeline forward. The 50-year charts do not care about the daily noise. They do not care about the dollar index. They do not care about the Fed meeting. They see the long arc of history. And the long arc says gold, silver, and oil are repricing for a new world. A world where paper promises are worth less and physical assets are worth more. That is the world we are entering. These three charts are the roadmap. Drop a comment. Tell me which chart surprised you the most. Gold's 3 bull moves, silver's cup and handle, or oil at 369. Tell me if you are accumulating during this consolidation or waiting. I will pin the best analysis. Share this video. These 50-year charts are the most important charts I have shown on this channel. Most people are trapped in the daily noise. Help them zoom out and see what is really happening. If you are new here, hit subscribe. Ladies and gentlemen, Growth Grid is here. I cover the long-term chart patterns, the comics data, the war impact, and the physical versus paper disconnect that is defining this era. Links in the description. This is the Growth Grid. Silver at 80, gold at 5,000, oil at 85. The daily charts show chaos. The yearly charts show destiny. Silver's 45-year cup and handle targeting 370 to 500 plus. 250% gains in 1 year and now consolidating for the next leg. Gold's 53-year 3 drives up pattern in the third and final bull move. First move 2,400%, second 900%. Third one is underway, and it is the one that resets the monetary system. Oil's 21-year inverse head and shoulders, targeting 369, the largest supply disruption in IEA history, 8 million barrels per day gone. Physical Dubai crude trading $38 above paper. Monetary metals paying 12% to lease silver from retail investors. StoneX desperate for physical metal. Shanghai premium 13%. Reuters saying paper oil is separate from reality. Comics longs rolling backward for immediate delivery. And silver sitting at $80 after giving 250% in 12 months, consolidating within the greatest breakout in its history, while the smartest money on earth fights over every physical ounce. 3 charts, 45 years, 53 years, 25 years. 3 targets, $500 silver, 369 oil, a gold price that resets the global monetary order. And the paper markets telling you everything is fine, while the physical markets scream shortage. The charts do not lie. The lease rates do not lie. The delivery data does not lie. Only the paper price lies. And paper lies do not last forever. This is accumulation territory. Growth Grid here. I will see you in the next one.